What if the next market shock doesn't come from a chart, but from a headline that breaks while markets are closed? What if war risk, rising rates, and an overheated tech sector are quietly lining up, not as separate events, but as one connected chain reaction? History shows this pattern clearly. Confidence breaks first, liquidity follows, and only then do prices collapse. AI optimism feels unstoppable right now. Stocks feel protected, currencies feel stable, but that's exactly how the last cycle felt, right before it snapped. Gold and silver are already moving, not in panic, but in preparation. And the question isn't if something breaks, it's what breaks first. Because when it does, most people will realize too late that the warning signs were already screaming. Welcome to Boring Currency Registry. Now, if you've lived long enough to remember more than one boom and bust, you already know this truth. Markets don't collapse loudly at first, they whisper. So if you value calm thinking over noise, experience over hype, do yourself a favor and subscribe. Not for excitement, but for clarity. And before we continue, tell us something simple in the comments. Where are you watching from today? The global system is entering a dangerous phase, not because of one single event, but because several pressures are converging at the same time. According to longtime trend forecasters like Gerald Celente, this is how major disruptions usually begin, not with panic, but with quiet signals that most people ignore. One of those signals is rising geopolitical tension, especially involving the United States and Iran. Iran is not just another country in the news cycle. It sits near some of the most important energy routes in the world. A large share of global oil flows through nearby choke points. When tensions rise in this region, markets do not wait for war to start. They react to the risk of disruption. Energy traders begin adjusting prices. Insurance costs rise. Shipping routes become more expensive. All of this feeds directly into inflation. At the same time, the global economy is already fragile. Governments are carrying record levels of debt. Central banks spent years keeping interest rates low to support growth. The cheap money encouraged borrowing, speculation, and high asset prices. It worked for a while, but it also created a system that depends heavily on confidence. Once confidence weakens, the system becomes unstable. This is where geopolitics matters. War risk acts like a stress test. It forces markets to confront reality. If energy prices rise sharply, inflation follows. If inflation rises, central banks face difficult choices. They can raise rates and risk damaging the economy, or they can keep money loose and weaken their currencies. Neither option is painless. History shows this pattern clearly. In past decades, major conflicts often exposed existing financial weaknesses. The conflict itself was not always the cause of the crisis. Instead, it revealed problems that were already there. Too much debt, too much leverage, and too much reliance on stable conditions. When those conditions changed, the system cracked. Another important detail is timing. Major geopolitical actions often happen when markets are closed, on weekends or holidays. This is not accidental. When markets are closed, leaders gain time. They can shape the narrative, coordinate with allies, and prepare responses before prices react. When markets reopen, investors are forced to react quickly, often with limited information. This leads to sharp moves in currencies, bonds, and commodities. Currencies are usually the first to feel stress. They reflect trust. When investors sense uncertainty, they move away from currencies tied to heavy debt and political risk. Bonds come next, as yields adjust to inflation expectations and policy changes. Commodities, especially energy and precious metals, respond as hedges against instability. Gerald Celente often emphasizes that war risk should not be viewed in isolation. It is a trigger, not the root problem. The root problem is a financial system stretched by years of easy money and growing obligations. Geopolitical shocks simply pull the curtain back. For business leaders and young entrepreneurs, this matters deeply. Markets are not just numbers on a screen. They influence borrowing costs, consumer behavior, supply chains, and investment decisions. When uncertainty rises, capital becomes cautious. Projects get delayed, hiring slows, risk appetite changes. The key insight in this first phase is simple but uncomfortable. The global system looks strong on the surface, but it relies on stability to function. When that stability is threatened by war risk, energy shocks, or political conflict, the weaknesses become visible. This is why the current moment deserves attention. It is not about predicting a specific event. It is about understanding the structure of the system. When debt is high, confidence is fragile, and geopolitics turns hostile. The margin for error disappears. Part 1 establishes the foundation of the warning. Conflict risk is rising, but the real danger lies beneath it. The system is already under strain. The next sections will explore how this pressure moves through markets, starting with technology and valuations, and why certain assets begin sending signals long before the crisis becomes obvious. In periods of economic stress, markets often look strong right before they weaken. This is not a contradiction, it is a pattern. When uncertainty rises in the real world, investors search for stories that feel safe. In the current cycle, that story is technology. Artificial intelligence, automation, and digital platforms are being presented as solutions to every problem. According to several market historians, this mindset closely resembles the late 1990s. During the original dot-com era, investors believed technology had removed risk from markets. New companies promised future profits without showing present earnings. Valuations were justified with growth projections instead of cash flow. As long as money was cheap and confidence remained high, the system appeared stable. But once interest rates rose and expectations shifted, the illusion collapsed quickly. Today, the same logic is returning in a new form. Large technology firms dominate market indexes. A small group of stocks is responsible for most market gains. This concentration is not a sign of strength, it is a sign of dependence. When too much capital flows into a narrow part of the market, it creates fragility. If sentiment turns, the exit becomes crowded. Low interest rates played a major role in this shift. When borrowing costs are low, future earnings look more valuable. Investors are willing to pay higher prices today for profits promised years ahead. But when inflation rises and rates stop falling, those future profits lose value. This is how valuations compress, sometimes suddenly. Another warning sign is behavior. Retail participation has increased. Short-term trading has become popular again. Many investors speak with certainty about outcomes that are inherently uncertain. This confidence is not based on data, it is based on narrative. In past cycles, this type of confidence appeared near market peaks, not bottoms. Gerald Celente and other trend analysts point out that bubbles do not require everyone to believe. They only require enough belief to push prices beyond fundamentals. Once that happens, the system becomes sensitive to shocks. A geopolitical event, a policy change, or an earnings disappointment can act as the trigger. The term dot-com bust 2.0 does not mean history will repeat in exact form. The companies today are larger and more established, but the structure of the market is similar. High expectations, concentrated gains, and dependence on low rates create the same vulnerability. When conditions change, repricing happens quickly. This matters because technology is deeply connected to retirement funds, institutional portfolios, and global indexes. A correction in this sector does not stay contained. It spreads, confidence weakens, credit tightens, spending slows. The impact moves from screens to the real economy. For entrepreneurs and business leaders, the danger lies in timing. Many expansion plans are built on the assumption of stable markets and easy capital. If valuations fall and funding tightens, those plans face pressure. Businesses that rely heavily on optimism and leverage feel the impact first. Another overlooked factor is psychology. When markets rise for long periods, risk feels normal, caution feels unnecessary. This is when discipline fades. But markets eventually force discipline back into the system. They do so through losses. Part 2 highlights a central risk. While headlines focus on innovation and growth, underlying conditions are shifting. Rates are no longer falling. Costs are rising. Geopolitical tension adds uncertainty. In this environment, stories become less powerful than balance sheets. The technology illusion works until it doesn't, and when it breaks, it rarely gives warning to those inside the crowd. The next section will examine how capital responds when confidence in paper assets weakens, and why attention quietly turns toward hard assets and monetary protection. When financial systems approach a turning point, the most important changes do not happen loudly. They happen quietly, through slow shifts in capital behavior. Prices do not always signal danger first. Positioning does. Long before headlines turn negative, experienced investors begin adjusting where they place risk. This is the phase the global market appears to be entering now. In uncertain environments, capital seeks protection, not excitement. This does not mean panic selling. It means gradual rebalancing. Funds reduce exposure to assets that depend heavily on confidence, leverage, and future growth. At the same time, they increase exposure to assets that historically hold value during instability. This shift often goes unnoticed because it lacks drama. Gold and silver have played this role for centuries. They are not promises. They are not dependent on earnings or management decisions. They do not carry counterparty risk. When currencies weaken or political risk rises, these metals regain relevance. Their movements tend to be slow at first, almost boring. That is precisely why they are often ignored. What makes the current period different is the background. Inflation has already reduced purchasing power. Government debt levels are high. Central banks are limited in how aggressively they can respond to shocks. In past cycles, they could cut rates and inject liquidity without immediate consequences. Today, those actions risk reigniting inflation and weakening currencies. This constraint changes investor behavior. Instead of relying on policy support, capital begins seeking structural safety. This is when gold and silver move from being speculative assets to strategic ones. Large institutions do not announce these shifts publicly. They execute them quietly, over time, to avoid moving prices against themselves. Silver holds a unique position in this process. It functions both as a monetary metal and an industrial input. During periods of economic transition, this dual role creates tension. If growth slows, industrial demand weakens. But if currency confidence falls, monetary demand rises. Price becomes a reflection of which force dominates. Another important signal is the behavior of central banks themselves. Over recent years, many have increased gold reserves. This is not a short-term trade. It is a long-term decision. Central banks think in decades, not quarters. Their actions suggest preparation for a world with higher volatility and lower trust. Currencies also provide clues. When capital moves toward safety, it does not always flow into one dominant currency. Instead, it spreads. Investors reduce exposure to heavily indebted systems and diversify risk. This fragmentation reflects declining confidence in a single global anchor. For business leaders, these shifts matter even if they do not trade metals. Currency stability affects import costs, profit margins, and pricing power. When money becomes less predictable, planning becomes harder. Companies with thin margins feel pressure quickly. The key insight of this phase is that markets are already adapting. The adjustment is subtle, but it is happening. This is not about predicting a sudden collapse. It is about recognizing a slow transition from risk-taking to risk management. Gerald Celente often notes that major financial changes are recognized only in hindsight. By the time the public notices, prices have already moved. The early signals are dismissed because they do not fit the dominant narrative. Part 3 reveals that capital is not waiting for confirmation. It is positioning ahead of it. Gold and silver are not rising because of fear alone. They are responding to constraints, debt, and geopolitical uncertainty. The final section will connect these movements to the broader outcome, how these shifts could reshape markets, currencies, and economic power in the period ahead. Every economic cycle ends the same way, not with a single dramatic event, but with a gradual realization that old assumptions no longer work. This final phase is where strategy matters most. Those who understand cycles adjust early. Those who ignore them are forced to react later, often at a higher cost. At this stage, the global system faces several limits at once. Debt levels restrict government flexibility. Inflation limits central bank responses. Geopolitical tension increases uncertainty. These forces do not act independently. They reinforce each other. When one pressure increases, the others become harder to manage. For decades, the dominant assumption was that growth could always be stimulated through policy. Lower rates, more liquidity, and fiscal expansion were seen as reliable tools. That assumption is now under strain. Each use of these tools produces smaller benefits and larger side effects. This is a classic sign of a late cycle environment. Markets respond to these conditions by changing what they reward. In early cycles, growth and risk-taking are rewarded. In late cycles, resilience and balance sheet strength matter more. Companies with strong cash flow, manageable debt, and pricing power gain relative advantage. Those dependent on cheap financing struggle. This shift also affects currencies. When confidence in policy declines, trust in money weakens. Currency values become less about economic theory and more about perception. Investors ask which systems appear stable, disciplined, and credible. This evaluation happens constantly through capital flows. Gold and silver fit into this outcome not as speculative bets, but as reflections of trust. Their role is not to replace currencies, but to signal stress within them. When these metals rise alongside uncertainty, they indicate that confidence is being questioned. The phrase massive gold-silver shift does not imply sudden chaos. It describes a reallocation process. Over time, portfolios change, reserves adjust, long-term strategies evolve. The shift is massive in scale, not speed. It unfolds quietly, then becomes obvious only after it is well underway. For entrepreneurs and decision makers, the cost of ignoring this process is high. Planning based on outdated assumptions leads to fragile strategies. Businesses that overextend during uncertain periods often face difficult corrections later. Those that preserve flexibility gain options. Another critical factor is time horizon. Short-term thinking dominates late cycles. Many focus on immediate performance and quarterly results. But long-term stability requires accepting slower growth in exchange for durability. This trade-off is uncomfortable but necessary. Gerald Celente's broader warning is not about predicting exact dates or events. It is about recognizing direction. War risk, market concentration, and hard asset movement are signals pointing the same way. They suggest a system transitioning, not collapsing overnight. History rewards those who study cycles rather than headlines. The dot-com bust, the financial crisis, and other major resets followed similar patterns. Confidence peaked. Risk was underestimated. Then conditions changed. Part 4 concludes the strategic warning. The current moment is not about fear. It is about awareness. The system is adjusting to limits that can no longer be ignored. Those who prepare early maintain control. Those who wait for certainty usually find it arrives after the opportunity to act has passed. This is the essence of the cycle now unfolding, quiet, complex, and decisive.